everyone. This is Christopher Aaron. It's the 14th of September, and we're going to look at a few different things today. The bond bubble that I've been speaking about recently is showing some signs of cracking, and I think this is going to be very important for basically all of the markets, and it's really going to impact all of our lives, I believe, over the next 10 to 20 years. And we're seeing just the initial signs of this right now, so I'm going to look at that, do something a little bit different. The metals have been consolidating still for all of the summer, essentially in these ranges, 1300 to 1378 on gold, and silver between 1850 and just above 21. So there's not a whole lot new there, but these consolidations are going to break at some point in the not too distant future, and I think these are the fundamentals to understand as far as why. Looking at the consolidative action here just for a moment in gold and in silver. So most of us are hearing about in the news increasingly information about the Fed and the next meeting that's coming up on Wednesday, a week from today, where they're going to release another decision on interest rates, and it's almost reaching a fever pitch. If you ask me, there's this obsession with what is the Fed going to do? Is the Fed going to raise interest rates? What is the Fed going to do? And I wanted to put this a little bit in perspective. And if you are new to studying the financial markets, and the financial markets are interrelated into so much more, because especially when it refers to the Fed, this impacts bond rates, interest rates, which impacts mortgage rates and our ability to buy houses and the government's ability to fund social programs and fund wars and all sorts of things. So there's so much of a relationship here between what's happening, what has been happening at the Fed, and what is going on in the rest of our lives. And I wanted to bring this point up, which is that keep in mind when you read in the news that the Fed is lowering interest rates, or the Fed is buying mortgage-backed securities or bonds, here is how they do it, shown down here in the orange shade. When the Fed buys government securities or extends loans through its discount window, it simply pays by crediting the reserve account of the member banks through a book entry. Now, this is a very wordy explanation for what a book entry, meaning they type some numbers into a computer and they buy hundreds of billions of dollars of bonds with money that never existed before. So it's the modern equivalent of printing money. This is how the Fed keeps interest rates at record lows, where they have been for the better part of the last 9 years. So the evidence for this, if we look at the Fed's balance sheet, and mind you, this is basically a record keeping of how much money they have printed, here is the unprecedented situation that we find ourselves living through between 2008 and today. Here we have the history of the Fed since post-World War II. There is a line here. This line you can barely see, however, because it's so close to this axis at the bottom. And then starting in 2008, when the Fed started monetizing all sorts of debt, bailing out all the banks, bailing out foreign banks, bailing out companies, bailing out Fannie Mae and Freddie Mac, this is the amount of money that they have printed in order to do that. So it's gone from basically a couple $100 billion on the Fed's balance sheet to close to $3 trillion today. So this is unprecedented. And we're not seeing the effects of this yet, but this is brewing. So they've printed all this money, and what have they done with that money? They've been buying government bonds. Now, government bonds, for example, here is the U.S. 30-year bond, often called the long bond. Government bonds have been rising in price for the last 36 years. This is unprecedented. And you can make the case that, okay, bonds were rising for fundamental reasons at certain points throughout the last 35, 36 years. For example, the crash of 2008, people fled into bonds. You can see the spike here. And then the spike came back down as the recovery commenced. But what's been going on, especially here over the last 7, 8, 9 years, you can see what was an orderly rising channel in bond prices is starting to become parabolic. So you have the Fed printing money to buy bonds, especially short bonds, and here we have long bonds that are also rising in price. Why is that? Well, if you're a saver, let's say, in US dollars, and you're trying to earn an income on a CD or a savings account, and you're putting your money into a savings account and you're earning less than 1%, it makes sense for certain individuals, certain corporations, pension funds, to take that money out of a low-yielding 1% short-term bond and put it into a long bond that is earning closer to 2%. So basically, the Fed, by buying the entire short end of the bond curve, is forcing the rest of the market into the long end, which is also bidding up the long end. And this is starting to take on bubble characteristics, not only in this country, but in other countries where you see negative interest rates. In Japan, in Germany, in Ireland, you've seen negative interest rates in a lot of these developed economies, meaning you are paying the government to get your money back at a loss in the future. If that's not irrational behavior, I'm not sure what is. So you're looking at what was an orderly rising trend channel here in bond prices that is starting to take on the beginning of this parabolic curve. And if you study bubbles in history, this is what the beginning of a bubble looks like. Now, it's possible that this bubble has already popped and is in the process of coming back down, or there may be one final shoot up higher than any of us can imagine in bond prices. And what is the inverse of bond prices? It is the interest rates. So you can see interest rates have been falling for 36 years. This has never happened before. So if you are an investor who's been looking at these markets for the last 5 or 10 years, or the last 30 or 40 years, basically, all you have known is a falling interest rate environment. So we don't know what is going to happen after this reverses, because our governments, our pension funds, our militaries, our school systems, our healthcare systems have all become dependent on being able to borrow at abnormally low interest rates, which has been fueled by central bank money printing. This is not going to end well when it ends. And there are some warning signs that this is in the process of changing. Here we are looking at just the last 5 days worth of action in a few different markets. Now there's been a lot of fear. What did this begin with? We've seen the stock market falling over the last few days. Here you can see since the 8th of September, US stocks is represented by the S&P 500 down almost 3%. Now notice the correlation here. What has fallen along with stocks? Bonds. This is very different than what has happened through most stock market sell-offs in the past. Typically, bonds are seen as safety assets. So if stocks were falling over the course of a few days, you would see bonds rise. Here you're seeing bonds falling at the same time as stocks. This is really unique. This is really rare. We don't have a precedent for this. And granted, this is only 5 days worth of action. But when we back up and we look at the experimental nature of what we are living through here, it's like a mad science experiment, basically. And they don't talk about this on the news. They don't talk about this in the Wall Street Journal. But we literally are living through this experiment right now. We have here showing all the gold that has ever been mined in the history of mankind compared to a human being, compared to one of the great pyramids. We have here in 2009, the last that this data is available, courtesy of Sprott Asset Management, we have the percentage of world assets that are comprised by gold and gold mining equities. Now, what's interesting about this 2009 figure is that the prices today are very similar to where they were in 2009. Gold was just above 1,200 in 2009. It is just above 1,300 today. Silver was roughly the same, and the mining equities, a lot of them are a lot lower. So this figure is very similar to what it was in 2009. And here we can see at some of the previous precious metals peaks, especially the early 80s and in the midst of the Great Depression, the percentage of gold and gold mining equities as a fraction of total global assets are basically nowhere near what they were at previous peaks. You'd be talking a 20 or 25-fold move higher in order to reach those previous peaks. And what is another evidence for that? Look how much higher, once again to come back to this chart, look how much higher bond prices are than they were in 1980. Bond prices have been rising for 36 years. Can we imagine what would happen if bond prices were falling for 36 years? And interest rates rising for 36 years? What if our mortgages were 15 or 20% per year like they were in 1980? What if the government owing $15-16 trillion had to refinance that at 10 or 15% interest rates? It could not afford to do so. So the Fed is caught between a rock and a hard place right now, and there really is no precedent for what we are witnessing. That's the thing to understand. We are living through this mad science experiment, but it seems normal to us. It seems like all we know is that governments can continue to borrow money forever. They can keep spending money for wars or for social programs or to bail out banks. And it's not to get into a political debate, but me personally, I would much rather see 2/3 of that budget slashed, i.e. slash the wars and slash the bailing out of the banks, and instead help people out when people really need. If the government is going to spend money, I would rather them spend money to help people as opposed to blowing people up. But the point of it is, all of this has happened because of the money printing, which has lowered bond rates, bond yields, interest rates to record lows. We are living in the final stages of the first known bond bubble in history. For many of us, it is all we have known for most of our lives. And following this video, I'm going to put a little animation on here. It's a little allegory of Plato's cave. And the allegory will be self-explanatory. But I see this as very relevant to our situation here as world citizens. That we essentially have been trapped in this cave as prisoners. Trapped in central bank manipulation and money printing. And for many of us, it's all we've ever known. And especially for those people who are not watching this video. Because if you're watching this, you're pretty much tuned in to one extent or another. But it's really the 99.99% of people out there who are not watching this, who have no idea what the Fed even is, what interest rates are, or how the Fed manipulates interest rates by printing money. So I'm going to put this allegory of Plato's cave after this video. It's a really well done claymation video that just gives a different perspective on what it would be like to see outside of the control mechanism that we have all been a part of for the last 36 years. The size of the global bond market is roughly 100 trillion today, and all the gold that has ever been mined in the history of the world is roughly 7 trillion. So 7%. Where will people turn if stock and bond prices continue to fall for the first time together, as we've seen over the last week? Typically, these things move opposite, and we are seeing bond prices fall with stock prices. This is very rare to see. When all else fails, what can we learn throughout history when we study these cycles that have happened over the last several thousand years? People return to gold. And as we saw in the chart of the percentage of assets that are currently allocated to gold compared to where they were at previous gold peaks, we are nowhere near a peak now. That said, this does not preclude extreme volatility in gold and silver prices along the way. Keep in mind, all of these things can happen, and gold can still be in a rising trend even if we see $50 or $100 moves lower over the course of the next several weeks. I'm not anticipating that. I actually think a breakout is due here in gold at any point now. I'm just saying that what we're living through from a historic standpoint is much, much bigger than any of these short-term fluctuations that we're observing. Thank you for watching. We're going to start the Plato's Cave allegory.
Imagine prisoners that have spent their entire lives chained deep inside a cave. They have been chained so that they cannot see behind themselves, and they are forced to stare endlessly at the cave wall in front of them. Behind them, a fire is burning, and between the prisoners and the fire is a raised walkway. Now imagine that each day a menagerie of objects crosses the walkway. Animals and people carrying their wares to market. Their shapes create an intricate shadow play on the wall in front of the prisoners. This is the only world that the prisoners have ever known. The shadows and the echoes of unseen objects. Now, imagine that the prisoner is released. After some time adjusting to the blinding light, the freed prisoner will begin to experience the world outside of the cave for the very first time. And it is like nothing he could have ever imagined. With his new perception of the world, the man will of course want to return to his friends to share his incredible discoveries. But the prisoners cannot recognize their old friend. He appears as all things do. His voice is a distorted echo, and his body is a grotesque shadow. They cannot understand his fantastic stories of the world outside of the cave. To them, it will never exist. This, of course, does not make the world outside of the cave any less real.